Hi there, Ken Beaton here from Arca Wealth Academy. Welcome back once again to this week's video. Last week we were talking about why real estate and why it's so important for you to understand the true profit centers in real estate. Unlike investing in the bank or investing in the stock market where you only have one, maybe two different profit centers, in real estate you have multiple profit centers. Extremely important for you to understand for your own benefit, but also for the benefit of others as well. So here's something I didn't share with you last week. Is the more people you help, the more money you make. So by helping other people, I'm talking about educating other people about the benefits of investing in real estate. They may not want to get into the game of investing themselves, but they may want to invest with you. And by sharing this information and educating them about the benefits of investing in real estate, that's helping them achieve their financial goals, plus it's helping you achieve your financial goals as well. A true win-win. Now, one thing I didn't mention was I have this little book called Creative Real Estate Investing for Canadians. Now, yes, it says Canadians. However, it doesn't matter whether you're in the U.S. market or whether you're in Australia or Europe. The principles apply across the board. It doesn't matter where you are. It's a very simple, easy book to read. It's for beginners. And what it does is it helps people understand the different profit centers and the benefits of investing in real estate. It's a great tool that you can leverage to help educate others. This is available online on our website, so check it out. Now, getting back to why real estate, today what we're going to talk about and focus on is cash flow. So we're actually going to talk about the difference between cash flow and profit. Two very different ideas that you need to be clear on. So first of all, let's talk about cash flow. What you have to look at is all of the income related to that particular property. Now that is going to include your rent. It could include laundry charges if you have on-site laundry. It could include parking. You could be charging for parking spaces, or if you have parking garages, you might be able to charge for that as well. Advertising. So for example, if you have a building in a prime location that's great visibility, you might be able to rent a sign on top of the roof or on the side of the building and charge a monthly fee to generate more income for that property. Depending on where you're investing, what province or state that you're investing in, depends whether you can charge for pets or additional tenants. There's a lot of different ways you can generate income in the property, but the bottom line here is all sources of income related to that property form that income. Then what you do is you take away all of the related expenses to that property. So these related expenses could be your property taxes. Not could be, they will be. It could also be your property insurance. It could be your property management company. It will be your utilities, which will include your natural gas or your oil, depending on what source of heat you're using. It will include your electricity, your water and sewer, all of the utilities that are required to run that property. Maintenance. So you need to maintain the property. You need to change windows occasionally. You need to change carpets, sand floors, paint units. All of these costs are part of the maintenance to that property. We'll talk about how much maintenance should cost in future segments. What else is we got here? Well, who's going to cut the grass? There's a cost of cutting the grass. Or if you're in the northern climate, there's snow to be taken care of. So all of these are related expenses to that property that are going to impact the cash flow. Now here's the one that's a little bit controversial, and that is your debt service. Your debt service, and we're going to get into this in more detail shortly as well, is made up of two parts. Your principal pay down and your interest. So I'm going to put principal and interest. Okay? From a cash flow perspective, So strictly from cash flow, and that's the money that's left over every month that goes into your pocket. From that perspective, you take all of the debt service. Okay? So that's related to your cash flow. And the money that's left over equals your cash flow. Now my goal when I am looking at multi-unit properties is a minimum of $75 per door. Now I prefer it to be $100 to $200, and it's that much more profitable. If it's less than $75 per door, I really have to question whether this is worthwhile investment or not. Okay, so that's my minimum based upon the cash flow. But then there's the profit. What is the profit? Well, the profit is almost the exact same thing. It's all of the income less all of the expenses except for the principal pay down. You do not include the principal pay down for your profit. So that means at the end of the year when you report your income to the taxman to pay your taxes, you're going to take all of your income less all of your expenses, including your debt service, but only the interest portion. That's the taxable, tax-free portion of it. The principal is taxable income. So for your profit, it equals your cash flow plus your principal. Your principal pay down. Now this is commonly overlooked by people, and at the end of the tax year what they report on their income tax reports is the cash flow, but that's going to be less than the profit. So if and when they get audited, the auditor is going to come in and say, well, hang on, you owe more taxes because you didn't show the principal pay down portion of your mortgage debt. So you need to be very careful about that. Quite simple, an easy way to look at that is if there was no debt service on that property, then your profit and your cash flow would be the same. But because there is debt service, you're making a mortgage payment which makes up your principal and your interest. Therefore, that's reducing your cash flow and increasing your profitability on that property, which is what you pay tax on. So that's the difference. I know it may be a little bit confusing. I always urge you to sit with your accountant and make sure that they explain it to you from their perspective as well, so that you are reporting the proper numbers at the end of each year, because the last thing you want to find out is 5 years in the future when you get audited, they go back and say you owe us X number of dollars because you didn't report all of your income properly. So make sure you understand the difference and you follow the rules correctly so that you don't get dinged unexpectedly. All right, thank you very much for today. I look forward to talking to you again next week. Bye now.